Okay, this is going to be a video on closing entries. So here it's asking us to close these accounts. Remember, you close revenue, you close expenses, and you close drawing to capital. So these are the accounts that need to be closed. And all of these will be closed and everything will end up in this capital account. So one thing that I noticed with students was that they didn't quite understand what do we do with this 250,000. They try to put that in the entry, but just think of the 250,000 as your bucket of capital right now before you do your closing entries. So the first thing that you want to do is you want to close your revenues and your expenses to capital. So you close your revenue, and this will be hard for me to do just because this is not the pen that I typically use for this. So just bear with me on the entries. I'll write as neat as I can. So you're going to, you typically credit revenue when you record it. So right now, revenues T account or fees earned T account has a credit of $125,000. That is its balance. So if I want to close out this account, I need to debit fees earned. And I'm just going to abbreviate for now, just so I can show you. All right, so when we debit fees earned, then now it has a zero balance, okay? But now I need to close my expenses. So all of these expenses have normal debit balances, so we need to credit our expenses. So we have wages expense, rent expense, supplies expense, and miscellaneous expense. Okay, so that is 30,000. Okay, and then rent expense is 15,000. Supplies, and then miscellaneous. So basically what I have done, I will just show you with wages. I won't do all of these. Wages expense had a 30,000 debit balance. Okay, so to close it, you need to credit it. So we're going to do this to all of our expense accounts. Okay, now what are we closing these to? Well, we're closing these to capital. So what we need to figure out, well, first of all, let's add all of our credits up here. If we added these up, 45, 51, I think it's 54,000. We have a total on the credit side, 54,000, and then 125,000 of fees earned. So fees earned is 125,000. That's your revenues. You can do your little income statement over here. So you can see that we have a net income of 71,000. So we need to put 71,000 here and credit capital. Anytime you have net income, that means you're putting more into the bucket because you have income, and income adds to the bucket. So if I go up here, 71,000, if I credit capital, 71,000, this orange here is 71,000 that I've added into capital. Now, capital, the 250,000 didn't matter for your entry, okay? So you don't really use that, but I'm just showing you that you added 71,000 in, and that gives you a new ending balance of capital of $321,000. So capital goes up by the amount of net income. Now, my bucket of capital has all those accounts in it. I've closed all those buckets or emptied all those buckets into capital. Okay? Now, what would be the difference? What if you had what if your expenses were more than your revenues? Then you would have a net loss. So let's make this, let me just show you this. Let's make this $130,000. Okay, well, if you made that $130,000, then that would make a net loss. Okay, so then you would end up debiting capital. Okay, so if you have a net loss, capital needs to go down, but you put capital wherever you need it in this entry to make your debits and your credits equal. Okay, I'm going to fix that back. 30,000. All right, that was the first entry. The new book, you do not have to use income summary anymore. Okay, that was that's how we used to do it, but now we just dump it directly into capital and just cut that account out. We don't need it really. Okay, it was just an extra step. Now I need to close drawing. Drawing has a normal debit balance, so I'm going to close drawing by crediting drawing. Okay, and I'm going to debit capital for the amount, which was $4,000. So what happens when you close drawing to capital? Let me just show you. Now what has happened is I'm going to take a little bit of this away, a little bit of my capital away. So capital is going to go down. This bucket is going to go down 4,000. Okay, so now the bucket only has 317,000 in it. Okay, so those are your steps to close revenue. You debit it. To close expenses, you credit them, and then you're going to either debit or credit capital depending on if you have net income or net loss. If you have net income, then capital is going to go up with the credit. If you have net loss, then capital is going to go down with the debit. And you always close drawing by crediting it and debiting capital. So anytime you close drawing, capital is always going to go down. But here, capital may go up or down depending on if you have a net income or a net loss. And you do not have to use the income summary account at all. Hopefully this will help you. Let me know if you have any other questions.